Hi everybody, welcome back to Quest for Alpha. If you're new here, then welcome. This channel is my way of documenting my trading journey as a full-time engineer, as a husband, father, and someone who doesn't have too many hours a day to stare at the charts. I actually just follow the charts a couple of minutes a day, and then I spend maybe an hour or so over the weekend to take a look at how things have been progressing, moving, and changing. I simply do this for accountability. I created a strategy, which is the one that I talk about on this channel, that is, at least for me, very easy to follow, very straightforward, and does not demand too much of my time. So today, instead of reviewing what had happened last week, what I wanted to do is something that I typically do with any strategy that I follow, is I go back in time and I analyze some of my trades. So what we're going to do today is we are going to look at all of the 23 trades that I have taken since November of last year. So that's a little bit more than 3 months of time frame. And we're going to take a look at how trade management can impact performance. Now, I did add some boundary conditions here. I maintained the same entries. It was the same stocks. It was the same 2-to-1 risk to reward. The only difference was how the stop loss was executed. So there's so many variables out there that one can pick and choose to use. In this case, I wanted to keep it simple, but I wanted to follow a method that can help me determine what the impact is of some of these different methods. All right, so let's take a look at this Excel spreadsheet that I put together very quickly. What I ended up doing is I copied all of the trades that I have taken since last November. We are simply going to focus on these 23 setups. The ones that are above here are marked in yellow. I'm excluding those from the analysis because they're still live trades, they're still in play. So we are only going to focus on the ones below here. Now, don't worry about every single row and what each means. I want you to simply glare at the bottom over here. We have the sum total of R, for reward gained for these 4 different methodologies or ways of managing the stop loss, the percent winners row, the average reward per trade, and then the drawdown. Now the drawdown, I just have them as highest, medium, lowest, as opposed to actual numbers, because I did not go through the effort of adding entry dates and exit dates for each of them. So, but I think you would be able to, if you scan the numbers properly, you'll understand what I mean by the drawdown. Okay, so as I mentioned, there are 4 methods. You can pause the video and you can take a look at what all of these actually mean. The first method is the flexible stop loss, which is very similar to the current approach that I follow and that I talk about in my videos. What it means is that I don't exit right away when the stop loss is hit. I actually wait for the price to develop. I'm really looking for a structure to see whether the price wants to move higher or lower. What is consistent though across all of these different methods, as I mentioned previously, is where the stop loss is positioned. So if we look at on this Equinox chart, you can see that this is the consolidation. That's our entry point once the candle breaks above the consolidation and closes above it. And the stop loss happens to be right below the consolidation, targeting 2 to 1. So that's very consistent. Now, what happens and how do you exit the trade if a stop loss is hit? So the first one says that if I come down here and I don't exit just because the flexible stop loss was hit. No, I'm waiting for the price to develop. I wait for a confirmation, a secondary confirmation to tell me whether I should get out or whether I should allow for the price to develop and hopefully get back up. The second method you can see here is a triggered stop loss. This means that this is completely mechanical. Stop loss is already fixed, it's predetermined. So if the price comes down and even wick through it, that stop loss is going to get activated and I would exit the trade. The third method is very similar to the second one that I just covered, but instead of a wick, what I expect to see is that a candle closes below that stop loss. If that happens, then I exit. So in this case, you wait till the end of the day, or in some cases, the very next morning to take a look at it. Ideally, at the end of the day, because sometimes prices can gap and you can be in a disadvantage that way. So that would be the third method. And then the fourth method is 50% stop loss. What does this mean? This means that we create a stop loss somewhere at the 50% of this consolidation range, somewhere halfway, which means that if the candle comes below 50% and closes below or at that 50%, then I exit the trade. So that just tells you that you minimize the loss. So over the last 3 months, if we take a look at all of the different trades, you can see that over a 3 months period, there was different market volatilities. There were definitely ups and downs. And while I follow very closely this first method here, there's obviously some changes to what I do, and that's mainly around the take profit. But with regards to at least hitting a stop loss and making sure that the take profit is 2 to 1, this would be the closest method that I follow. And this ended up being, in terms of like total R, the second best. The best performing one was the one where you would only exit the trade if the price section comes below the stop loss and there is a daily closure below it. And then the worst one was actually the last one. That one got triggered most frequently. And you can also see that in terms of like percent winners, that one had the lowest percent winners. It was around 47%. Now the method that actually won and giving us the largest RR was 65%, while my method was close to 70%. Now, this does make sense, the percent winners to be 70%, because you do allow the price to breathe a little bit. The average reward per trade, you can also see it here, and the third method actually performed very well. It's almost 0.94. So that's, it's close to basically 1 R per any trade one takes, which means if you take 100 trades and in all of those 100 trades you risk around $100, then you have gained almost $10,000 following this strategy. And then finally, what is the drawdown? You can see the drawdown is highest on the strategy that I follow closely. That's because very often the price can dip way below the actual stop loss. And sure, sometimes it can reverse, like in this case with CNA, and that ended up as a win, as opposed to any of the other methods that were actually considered a loss. And for the most case, you can see that some of the average losses are like around between minus 1.5 and minus 2. This method here, which I really like, and I only discovered this by simply analyzing some of the data, actually has a average losing trade around minus 1 R which is not that bad. And obviously, the worst performing one had the least amount of, let's call it the drawdown. Most of the losing trades were around minus 0.5 because that's where we determined we wanted to have the, because that's where I determined I wanted to have the stop loss, but there were just simply too many frequent losses. So it's almost like you want to allow the price to breathe, and in this case, you're exhausting the price action. So here's something that's pretty important. We are only looking at 3 months period and 23 trades. So I don't want to say that this is enough data to declare anything definitive. It's a nice directional evidence, but I wouldn't say it's like a scientific conclusion or anything like that. It is, though, important to have a method to analyze the trades and to try to iterate and improve on your methods from time to time and make few tweaks. I strongly believe in that, and that's one of the reasons why I decided to do some of these analysis. Now, let's move on to the charts to see some of these examples quickly. All right, so now we're on the charts. Basically, all of the 23 trades are below these active trades. Remember, I mentioned I'm not going to take these into account for the analysis, but anything that was in the achieved first target or previous close trades have been accounted in that Excel spreadsheet. And if we take a look at, for example, Equinox, this is an example where basically any of the 4 methods performed very well, and they all gave the same take profit. None of them hit the stop loss. Lin was another example where everything worked out pretty well. So all of the different approaches ended up with a profit. Ingersoll Rent was one of the stocks where 2 methods performed well, the other 2 did not. So which one performed well? This was my method where we had the flexible or imaginary stop loss, and that one was never really triggered. And the one where the candle closes below the stop loss was never triggered. However, the one that actually reached and touched the stop loss right over here, that would have been a -1 loss. And the one where we were looking at if a candle closes somewhere below the 50% of the consolidation range that the stop loss gets triggered, then this would have been a loss as well. So CPA is one example, again, where the first method achieved the take profit and the stop loss was never activated. The price never really closed below the range, so that also meant that I did not have to activate that stop loss. However, the option 2 or trade method 2 was actually triggered here, and this would have been a loss, even though it was really barely touching it here on this candle. However, the very next day there was a gap, the price dipped below, and even though it closed above, if you have this very strict mechanical method, these are the risks that you are going to face. All right, so I think this gives a good idea of the different methods and the different approaches I use to analyze some of the previous trades. And as I mentioned a few times already, the reason for this exercise is simple. It's easy to think that your way is the right way, but it's really hard to test it. And I simply don't want to just build belief. I want to be able to build evidence. So I want to demonstrate that with data. And ultimately, that's what Quest for Alpha is about. It's not about signals, hype, or any mystery. It's really about structured systems that allows me to refine it from time to time, to iterate around it, one iteration at a time, and to make improvements. If you're here for that process, then welcome. We will continue to refine it together. And with that, I want to close this session and wish you all have a great rest of your day. Thank you.